About 24 years ago, one of the world's biggest energy companies collapsed in a spectacular fashion. It was more spectacular than, the collapse of Prince Andrew's public reputation. In the process, they took down one of the world's largest accounting firms, a firm called Arthur Andersen. Now, if you do a bit of research on Enron, you're going to see words like complex and sophisticated. But like most fraud cases, when you break it down, it's actually quite easy to explain. The complex part for me is going to be trying to prevent you all from dying of boredom as I go through the technical aspects. So back in the cocaine-fueled years of the 80s, two small natural gas companies came together and merged into one. They were called Inner North and Houston Natural Gas, and they became the company that became Enron. Now, whilst listening to Bon Jovi and generally enjoying the excesses of the Reagan era, Enron controlled the second largest natural gas pipeline in the US. So although they were considered small, they certainly weren't insignificant. Now, at the start of the 80s, natural gas was regulated in the US, which meant that the government basically controlled the price in the market. But regulation in the 80s was just kind of like disco music. It started out cool, but it quickly went out of fashion. And natural gas was no outlier here. Natural gas was deregulated in the 80s, and Enron saw an opportunity with the deregulation to form a natural gas trading company called Gasbank. So here's where things start to get a little strange. Enron produces natural gas, they distribute natural gas, and they run the trading mechanism for natural gas, which could have been seen as a conflict of interest. But hell, it's the end of the 80s, everyone's consumed a lot of hairspray, and we pretty much look at it and go, yeah, sure, nothing's going to go wrong here. Now, struggling with the valuation of assets is nothing new in accounting. How do you value my 1984 Toyota Corona with a semi-functioning tape player? Well, the only way to do that is to actually sell it on the open market. The problem is once you sell it, it's no longer yours. So let's assume you have a company and you make stuff in a factory. You don't want to sell your factory because that's what you do. How do you actually value it? Now, accounting has struggled with this over the years, and we've come up with a couple of methods of valuing assets. One of those methods was known as the mark-to-market method. And it basically said if you had a commodity-style asset, you could value that asset at the price it was currently being traded. So the second issue with accounting assets is that when you run a factory and say the land that factory sits on goes up in value, you usually treat that as an extraordinary gain. You basically say, yeah, look, our company's now worth more money and we need to recognize that. But since we didn't really actually do anything, we can't consider it a normal profit. It's not a profit from operations. If you are a trading company and you make your profit from buying and selling assets, then you can argue that any change in value of the assets is actually a regular profit. After all, that's what you do. So getting back to Enron, they were a natural gas company. In late 1991, natural gas is deregulated and Enron decides to value its stockpile of natural gas using the mark-to-market method and then recognize any change in value of that stockpile as a normal trading profit. It's all above board, it's all legal, it's all within the accounting standards. So let's say go back to Enron. Enron run Gasbank, the trading company for natural gas, and they make gas and they distribute gas. So now we have more potential for shenanigans and a Puff Daddy freak-out party. Enron figures that come the end of the year, they can actually just cut back on the supply of natural gas going into Gasbank, market economics will kick in and the price will go up. And this is where they start to play with a house of cards. They begin to manipulate the market, revalue their inventory, and recognise a nice fat profit. The only problem, this is purely an accounting profit, and it's unstable. For a full explanation, see my video about taking a big bath. But basically, to keep this profit going year on year, you have to keep manipulating the market year on year, more and more and more, and eventually people are going to notice. After a couple of years in, Enron find themselves in a bit of a pickle. Everyone loves them. They're the darling of Wall Street. They're winning awards. Their life is fantastic. But the artificial profit means that they don't have a lot of tangible assets in their company to back up the stock market value. The stock market value is pretty much based on the fact that they make a good profit every year, and if they take the big bath, they're not going to make a profit, and that's going to mean that the value of their company drops dramatically, and this doesn't seem like a very good idea. So the company execs get together and they decide that they kind of like being the big dog on the block, and they kind of want to stay that way. By the mid-90s, Enron decided to cross the Rubicon and commit to the activity that's going to lead to the biggest corporate collapse in history. And what they do is they look at their books and they go, we've got too much debt. And someone says, well, why don't we sell the debt? Now, the problem is you can't sell the debt. That's just bad marketing spin. So they come up with a whole bunch of really tricky accounting instruments to transfer the debt off onto other companies. So they use things like leases, transfers, sales to actually transfer that debt to offshore companies that are either joint ventures or actually owned by the executive. The worst thing though is that although this is probably going to meet the legal threshold for a fraud, it's actually not against the accounting standards. So in comes the story comes Arthur Andersen, their auditors, and they say, hey fellas, we really don't like this, to which Enron goes, well, we might go and get ourselves another auditor. So Arthur Andersen goes away and they think about this for a while and they come back and say, look, we're really not okay with this, but hey, if you buy $30 million of consulting from our sister company, Andersen Consulting, we might feel a lot better about it. That's some classy moral low ground right there. When 2001 rolls around, questionable things have been going down in Enron for about a decade. They've been using all these accounting tricks to hide the reality that they're not actually making much money. In the end, like others before and like others since, the house of cards eventually does come crashing down. It started when a couple of people started looking into Enron and they were figuring out that Enron was making significantly bigger profits than their competitors. If you make 10% more than your competitor, happy times. If you're making 10 times more than your competitors, something's probably wrong. And then people looked closer and they found out that the numbers simply didn't add up. And like a celebrity making a racist comment, the bad press just came in a tidal wave. It became apparent that this company should have been bankrupt many times over. Arthur Andersen was sued by everyone that could spell the word lawyer. Andersen Consulting changed its name to Accenture and hoped no one noticed. But most of all, Enron, a company that had a stock value of $101 billion, went belly up, and they took a lot of investors' money with them. So, these investors were certainly not happy. And what do rich people do when they're not happy? Do they quietly reflect on their poor choices? Not a chance in hell. They ring up their elected officials and go, it's your fault, fix it. The fallout from Enron has continued to shake the accounting profession probably for the last 24 years. Enron was a new sort of fraud. And it was new because the main driver wasn't stealing cash, it was ego. Yes, the executive made money out of bonuses and the like, but the Enron executive actually liked being the big dog. They liked the praise. They liked being the darling of Wall Street. They were like influencers before influencers were even a thing. And as a result, the laws and standards at the time were woefully unprepared for this sort of crime. So America brought in a piece of legislation called Sarbanes-Oxley, or SOX. It's been superseded by SOX 2 now. And that was designed to limit companies' abilities to revalue their assets and then enshrine controls around what activities people can do. In addition, the global accounting standards got a boost. We moved from individual accounting standards across individual countries to one international financial reporting standard, which also has updated rules and controls. But in the end, if there's a lesson here, it's a fundamental one. Profits come from selling goods or services at a greater price than it costs to produce or buy them. That's literally the only way you can make a profit. If you can't figure out what a company is selling or how they're making a profit, no matter what legislation or standards in place, then maybe that profit doesn't exist. Guys, I'm Andrew Chapman. If you like my channel, smash the subscribe key. And if you want me to cover any other topics, please leave a comment in the comments down below and I'll see what I can do.